David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio, WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Good morning. This is Dave Weaver with SWC Wealth Management, and we're bringing you another round of User-Friendly Finance with the topic today is going to be risk and various kinds of risk. And we'll go through that and try to help everybody get a better understanding of the different types of risks that are embedded in financial investing. Just want to talk for a second about SWC Wealth Management. We have two offices. We're located in Palmyra and Carlisle. In Palmyra, we're at 103 West Main Street. In Carlisle, we're at 35 East High. Both of our offices are about a block off the square. And you can reach us for both offices at 717-706-0700 or via the web at swcwealth.com. We also have another number for Carlisle, which is 717-249-0453. We try to get back to every call within a day if we can do it, within 24 hours if we can possibly do it. If we haven't, give us a call back because maybe something happened with the message or we didn't get it or whatever. So feel free to get in contact with us. Joining me today is Megan Wall. How are you today, Megan?
I'm doing very well. Good morning.
Good morning. Bonjour. Megan is typically in our Carlisle office, and Tom Pop, who's here occasionally, he also is in the Carlisle office typically. They both spend about a day or two in Palmyra, but the bulk of the time in Carlisle, and I spend a day or so in Carlisle, and then the bulk of my time is spent in Palmyra. So we try to get service clients wherever it is most convenient for them. Again, we're on the East Shore and the West Shore if you want to give us a call and work with us. If you give a call in today, if you have any questions about the risk subject that we're going to be talking about, feel free to give us a call. The call-in number is 717-540-0580, or you can also reach us at
1-800-724-5801. 5801.
Oh, excellent. Okay. Yeah. Where I was looking, it's buried.
I know. That's why I jumped in there.
I should know that off the top of my head, by golly. Okay. So
we do welcome questions or comments.
Yeah, questions or comments. And if you could call in, we have a $10 Panera card. I still owe from 2 weeks ago. Last week we didn't have nobody had called in, but from 2 weeks ago we still owe the gift card. So I've got to get those out.
They are coming.
They are coming. If you are one of those three people, don't worry, they'll be there. This is the week. This is the week that they get out. We will not forget. I have the list at home, carrying it around, but I was out of town last week and wasn't able to get back to it. So anyway, today our subject is risk, and again, there are multiple kinds of risk. One of the things that we've been trying to work for, we talked about it a couple weeks ago, is the concept of True North wealth management. And I think gradually we may migrate our name to True North in our title, but the True North concept has to do with trying to have a financial plan that matches with your personal goals and your personal mission statement, your personal beliefs. And risk comes into play with a lot of that. As you just think about your life, think about the risk you're willing to take on, it becomes something that's critical. And it's not just your financial life, it's your life in general. As you go through life, you have different areas where risk comes into play. The financial risks are a little bit different, but the risk of changing jobs or going to college or not going to college, all those things, retiring or not retiring, are decisions that you make as you go through life, and you try to have your own personal compass that is sort of directing you as you go. And hopefully, as you start to deviate from where you want to try to go, you'll feel that you're out of step with yourself.
You feel that pull.
Yeah, you feel that pull, just like you do, and just like a compass is always pointed to the north. Your personal objectives, your personal goals, your morals, your compass that guides you is important in your personal decisions and your financial decisions. So we thought risk is an appropriate topic for finance, because a lot of people don't understand all the risk that's embedded in the different things that you invest in or can invest in.
Yeah, and I mean, also keep in mind we will be talking about risk in, burying your money in your backyard or sticking it under your mattress as well. There's types of risk embedded in any type of quote unquote investment that you might be making or way to store your money that you might choose. And there is one disclosure that we have to read when we talk about this, that any investments are subject to market risks, including potential loss of principal invested, and diversification does not assure or guarantee better performance and cannot eliminate the risk of investment losses.
That is important.
It is. It does help protect you, but we can't guarantee that past performance will guarantee future results, the same normal stuff.
Yeah, and I think that's, as you talk about the markets and the various types of investments, that definitely is important to keep in mind. And life does have ups and downs, and the market has ups and downs, and different types of assets have ups and downs, even if you think that they don't.
Mm-hmm. They definitely do.
I always tell the story of somebody that I know. He wasn't a client who buried money in the backyard and the cans started to rust, and then the money eventually was no good anymore. So it doesn't always work. Even burying money in the backyard doesn't always work. He eventually shifted to glass jars.
Glass jars. That's a better choice.
Yeah, glass jars with a map that only a few people knew where the money was. So
yeah, and it depends on if you live a really long time, because I think eventually they would start questioning those bills when they try to come back into circulation.
Yeah, and eventually, even the glass jars with a secret map has issues in terms of risk. Because what happens if you pass away unexpectedly and your map gets lost, or nobody has the map or can't decipher your map? Mm-hmm. Everything's got risk. So the topic today is going to be risk. If you have any comments, if you have any questions, if you want to participate in the show, give us a call at 717-540-0580, or what's the other number, Megan?
1-800-724-5801.
Okay, great. Okay, so the first thing we're going to talk about is market risk, which is what Megan essentially read that disclaimer for.
And that's what most people think of when they think of investment risk. But we just want to make sure that whatever you decide to do with your money, you understand the upsides and the downsides that you're exposing yourselves to.
Yeah, everything has some degree of risk associated with it in the world of finance. There's no simple, straight answer for just about anything when you get into the subject of risk in our world. The first thing that we want to talk about is risk of investments. And a lot of people, when we talk about market risk, we're talking about the risk of investments declining in value because of economic developments or other events that might affect the entire market.
So this is specifically talking about when everything is down, not necessarily just when one asset class does better than another.
Okay, so equity risk is the loss that because of a drop in the market, the price of your shares will drop. And that, sometimes that's buried. Like if you're investing in a 401k and you're doing systematic purchases, the value of your shares may actually be dropping and you don't know it because you're still continuing to make purchases. So it kind of shields that. But most, particularly with mutual funds as an example, you can go either on the internet, type in a ticker symbol. Almost every mutual fund has a 5-character ticker symbol that you can just type into your phone or type into your computer. It'll tell you the current value, and you'll be able to see the price per share. And if that's going up or down over time, if you're tracking it, that's what we would consider market risk. It's the value of your shares going up or down. Some of the things that shield that a little bit are dividends that may come out, and they'll actually, I guess this is going to be too complicated to get to before we end the break. So we better take a break right here, and then we'll come back and talk about market risk again. This is Dave Weaver and Megan Wall with User Friendly Finance and SWC Wealth Management.
Our newsroom's a lot like Santa's workshop.
Well, don't you all look very busy in here?
I'm getting all the stories together for the
top of the hour.
I like it.
Decking your halls with news, weather, and traffic year-round. News Radio WHP 580.
Hi, this is Dave Weaver and Megan Wall again with SWC Management and User-Friendly Finance. We're talking about the subject of risk, and maybe that's user-unfriendly finance is talking about risk. I don't know.
No. Education is important.
Education in this area is extremely important. So equity risk is the last subject we were talking about. Well, one of the things that makes the value of your shares a little bit tricky is, as particularly with mutual funds, as funds issue dividends or capital gains, is actually dilute your shares, but most people are repurchasing with the shares that they have. So you're going back and essentially if the dividend is $10, let's say it's $1 a share that they're distributing out, and that'll dilute the value of the fund by $1. Then you reinvest in it, just basically going back and keeping the value whole. So it gets a little tricky that way, but you can follow the price per share, typically in the internet, or some newspapers still carry some of the funds, but not many newspapers carry it anymore, like the Wall Street Journal does. But anyway, that's equity risk, the potential that your shares may drop in price due to the equity or bond market, because both stocks and bonds go up, and the risk is still considered equity risk. Tied right into that is interest rate risk, which is the risk of losing money because of the change in interest rates, which is about what we're going to have happen potentially this week with the Fed thinking about raising rates again. And over time, we're expecting the Fed's going to gradually keep raising rates at some point. Right now, the things that the Fed's in charge of are responsible for controlling our inflation and unemployment. Both of those are in pretty good shape right now, but interest rate risk, the way I try to describe this is, if you have a 10-year bond and it's earning 4%, and the average holding period of those bonds come in $1,000 increments. If the average holding period is 10 years, and the bonds in a mutual fund, and the rates go up, and all of a sudden now you can get 5% for a 10-year bond that you originally paid $1,000 for. In order to get the new 5% bonds, the mutual fund can't sell the 4% bonds. Yeah, they can't sell the 4% bonds, and nobody will pay $1,000 for them anymore. They may get $975 or $980, but they won't get the full value of the $1,000 you paid for them originally. So that's one of the best areas of seeing interest rate risk is in the bond area, and we're in a type of environment where you'll gradually see that over time. But it's confusing because people expect that with bonds, particularly bond mutual fund, they're distributing dividends every quarter or sometimes every month, depending on the fund. And a lot of bond funds will distribute every month. So you'll still be getting a dividend. It's just that the actual value of your shares will drop just because the fund can't trade out their lower interest bonds fast enough to try to get the rates that are available now.
Mm-hmm. And in this environment, because they're expecting all of those rate hikes, I think hikes sounds crazy since it's such a small number.
It's a small
seems.
Number. Yeah, it's 1.25.
But it can,
the Fed funds rate, which people don't really realize, is 1.25. If they raise a quarter point, it's 1.5. So it's not a rate that people see every day.
Mm-hmm.
It's about the same rate and probably above the rate that you're getting in your savings account right now. It's probably, depending on where your account is held and what the value of your account is, it could be double.
Savings account.
Yeah, it could be double the value you're getting in your savings account.
But because of that, when you look at the duration of the bonds in a lot of your mutual funds right now, they're much shorter than they would be historically. So an intermediate term bond today may be what a short-term bond was historically as far as duration. And that's because
when we talk about duration,
expected.
that's the average holding period of a bond fund.
Yeah, so it just means like a duration of a bond would be, this is a 10-year bond. At the end of 10 years, you'll get your money back plus whatever dividends you were paid during the time period. A long-term or an intermediate term bond will have shortened up the duration of those individual bonds that they're holding within it in order to prepare for that rate hike, because they are actively managing that and trying to put themselves in the best position they can for that risk. But at the same time, they're not rushing to ultra short term bonds in an intermediate term bond fund, because they have rules that say the way they need to be investing, and also because the shorter duration of the bond, generally the less dividend that you're going to get from that fund.
Yeah, it's a good example in the market that we're in now. Over time, we've gradually we've gravitated to shorter and shorter duration bonds. A short duration bond might have 0 to 2 years as an average holding period for the bonds that are in that portfolio. And Megan was talking about ultra short; they might be 3 to 6 months average duration. Intermediate is typically 5 to 7 years, and longer term bonds are considered 7 years or beyond 7 years. So those are the like general categories of bonds. And over time, we've been shifting our durations shorter and shorter because we're worried about the interest rate hike. The longer the duration of those bonds, the bigger the problem that we talked about, where if the average holding period of a mutual bond fund is 10 years, and they can't turn around the whole, like 1,000 bonds or whatever, they can't turn those around and buy them off a 5% bond all at one time. They have to do it over time. So it just takes time. So as a result of that, they're losing value as time goes by.
Mm-hmm.
So, and people are moving to other funds that can get that, that get the higher rates. But you'll typically have shorter rates in short-term bonds and higher rates in long-term bonds. Right now, we're in a kind of a dilemma type of period where short and long-term rates are kind of converging, and that typically is a precursor of a recession. We don't see that in the U.S. markets at this time, but that is something that, when people talk about that, that's what they're talking about, is a yield curve inversion,
Mm-hmm.
and that's what we don't want to see.
Essentially, we are, because of historically and what we know about our economy, it is better for our economy if long-term rates are higher than short-term rates,
and
because
usually quite a bit higher.
Yeah, people won't take the risk of buying bonds that have long durations if they're not paid more for those, and that is an indication
of potential problems if
Mm-hmm.
those start to invert. The next thing we're going to talk about is currency risk, which is the risk of losing money because of a movement in the exchange rate. And we talk about the exchange rate as what you can exchange one currency for another. Right now, the dollar is devalued in the current market anyway. The dollar is being devalued. One of the effects that you're seeing from that is that international funds are benefiting from the dollar devaluing, and that's why some of the good performance we've seen in international funds over the last year has been given some tailwind by the fact that the currency rate in the United States is going down. So
absolutely.
That's a really good example of currency risk.
Mm-hmm. And that points out something that I think is really important to realize, is that the value of the dollar being strong or being weak has good and bad implications on both sides. So that's important to keep in mind. So the fact that the US dollar is weakening gives us better performance when we invest internationally. It also makes the goods that we're selling more attractive to other countries. But then when we want to buy goods from other countries, that's where it hurts us. So you have to know, part of the reason why we're doing this show is making sure that you understand both sides of every story so that you get to make an informed decision.
Yeah, there's risk implied in virtually the whole world of finance. You just have to determine how much you're willing to take on and try to understand where you've got exposure.
Absolutely. And also, I know we've probably said it 100 times, but we don't think that you should have all of your money in one place ever. You should not have 100% of anything.
Yeah,
and that's
even
where we
100%
talk about,
cash.
Yeah, that's where we talk about that diversification, because there are different risks that affect different ways of investing, even if that investing is money under your mattress. There are different risks to each one of those things. So you want to make sure that you don't have all of your eggs in one basket.
Yeah, we talked a little bit about interest rate risk just a second ago, and back to the example of putting your money in jars. There, you're getting absolutely nothing for for your money. Inflation is typically historically run around 3%. So if you, let's say you put aside $100,000, you're losing 3% to inflation. You wait 20 years to use that money. That means your money has devalued by, $60,000 over that 20-year period of time. So what you're trying to buy with the cash that you've been storing in your jars is now worth $40,000, and you won't really be able to buy, a third of the things that you thought you were going to be buying, because inflation definitely eats away the value of your dollar.
Yeah, that's definitely very important.
So that's just another example of interest rate risk.
Yeah, and that's talking about loss of purchasing power, because you want your investments to at least keep up with inflation. You may have the same amount of money, the same number in your bank account, but you'll be able to buy fewer things with that amount of money in the future, which we all anticipate being true and hope to be true. Inflation is important. We don't want to have a high inflation rate, but that's a sign of a strong economy.
And the Fed's targeting 3% because they view, in the Fed's view of the world, 3% is an optimal rate that keeps the economy, plugging along at a reasonable rate, keeps unemployment down, and should be good for the economy over a long period of time. So with that, we'll take a break. We're going to get back to more of the subjects on risk. And if you have any questions or comments, feel free to give us a call, 717-540-0580. This is Dave Weaver and Megan Wall with User Friendly Finance. Christmas music. This is Dave Weaver and Megan Wall with User Friendly Finance. We're heading into the season. There's risk of spending too much money at Christmas time, that's for sure. I'm not sure if I'm in that boat, but I think, Megan, your mother might be.
You think?
I think. I think there's a decent possibility. The show today is brought to you by SWC Wealth Management. Well, every day. Every time we're on, it's SWC Wealth Management. We have two offices again. I just want to make sure everybody knows that we're in the East Shore and the West Shore. In Palmyra, we're at 103 West Main, Carlisle, 35 East High. We're a full-service financial planning company. Risk is just one of the areas that we try to help our clients deal with. But you can look us up on the web at swcwealth.com and look up our information, and you'll be able to see all the services we provide and a little bit of our contact information. We're currently in the process of updating our website, changing a little bit of our look, and we should hopefully have some of that in place by the beginning of the year, or at least, if not by the end of the year, by the beginning of next year. And I think you'll see, we're hoping that you'll be positively impressed with the changes that we're making there. You can, if you're a client of ours, you can access your account through that. You can also get different articles. There's different calculators, all kinds of information on our website at swcwealth.com. As it mentioned on the ad, right as we came out of the break, you can reach us during the week at 717-706-0700. That's our primary number, which will get a message back to either Carlisle or Palmyra, or you can reach us via the web at swcwealth.com. We have a call on line one. This is Richard from Lancaster. Hello, Richard.
Hello.
How are you today?
Good. I wanted to know about Bitcoins and how much of a risk they are, and how do you get them, or where do you get them?
Yeah, I honestly am not an expert on Bitcoin. I know very little about it. We're not allowed to trade them through our broker-dealer, and I think most traditional investment houses, you're not allowed to invest in Bitcoin. So I'm not sure exactly how you do it. I was at a meeting earlier in the week, and they had different hedge fund managers, different fund managers. Most of those people also don't consider themselves experts on Bitcoin, but it is a really commonly asked question. We're going to have to try to get educated on it. The whole block technology concept, I think, is something you can invest in, but you'd have to do a little bit of research maybe on the web. Bitcoin, I'm not sure specifically how you invest in that. And some of the other Bitcoin technology, or what do they call it, block technology, which is going to be the transaction mechanism probably in the future. They were talking in the meeting I was at about some of the big investors in this right now are some of the banks and credit card companies are starting to get involved because they see that at some point Bitcoin provides the ability to, or the technology provides the ability to bypass credit card companies, have you go directly do your transaction directly with the store. They're saying there's huge capability in the block technology for inventory management. I guess the short answer to your question is we're just not expert enough to talk about it, and I don't know. It's something we're going to have to get educated on because we do get a lot of questions on. Right now, I can tell you that we're through our broker-dealer, and I think through most broker-dealers, you can't invest in it.
You can't. And that's partially because of the amount of risk that's associated with investing in it.
Yeah, so
There's
your risk
nothing
question
you
is
can-
considered
yeah.
ultra-high risk.
There's nothing you can compare it to because there's nothing. I read an article that said you can compare it to money, you can compare it to a stock, you can compare it to a tulip. It has the same amount of correlation to any one of those things. It's nothing. It's not comparable to another type of risk that you've taken on. Right now, they said the intrinsic value of Bitcoin, of a share of Bitcoin, is about $1,000, but they're trading at about $13,000 because of the excitement and the anticipation of what it could bring. But unfortunately, we don't know. It's definitely has the ability to be something amazing. We just haven't seen enough that most broker dealers, they have to cover all the liabilities and make sure that we're doing the best things for our clients. They have huge compliance departments. So they're slower adopters of something that is new and doesn't have historical data to back it up. And that's why a lot of broker-dealers and financial advisors that are with broker-dealers are not going to be able to sell it at this point. So I think you may have to do some research on your own in order to actually purchase it for yourself.
And I guess to your risk question specifically, I don't know what we have that would be correlated to it in terms of risk. More like commodities or futures or
they compared
even
it
gold.
kind of to a commodity, but they still said that you can't necessarily say that it would follow like the risk pattern of investing in gold. I think there's actually a it links. I saw a Forbes article, 7 Lies Bitcoin Fans Will Tell Themselves and anyone else who will listen. So, but there's also, the author of this article also says, even though he's skeptical of Bitcoin, he also says he doesn't know. So, but it just gives you ideas of the other side. And it just links to a Wikipedia article that just is only talking about comparing to something that you can't make a comparison to, an equivalence fallacy. So I wouldn't even necessarily go there. But I would definitely say it has huge upside. It also, because of that, you're taking on risk in order to get that upside.
Yeah, it's like gold or oil. If you're in the futures of those, you have tremendous capability for loss. And here, where the intrinsic value is 1,000 and the true value and the price it's selling for is 14,000, it doesn't mean that 14,000 may not eventually materialize. But if it does drop to 1,000, back to what's more like the true value of the transactional capability, then you've lost that amount of money if you purchase it at the highest. Like, I think at this point it's almost too late to try to invest in Bitcoin. I don't know.
Yeah, it's hard to tell because it could just keep going. I mean, if it becomes what they think it's going to be, that's why it is. People are purchasing it for the price that they currently are.
Right. And it's one of the speakers, by the way, said that in his local town, I don't remember what town it was somewhere in the United States, that they had a Bitcoin machine similar to an ATM. And I don't know how that's going to actually materialize in the future. There are probably going to be other competitors for those types of transactions. Anyway, I don't think we answered your question.
Well, it's more than I knew before, so.
Well,
we definitely try, and if you want to shoot us an email or call us during the week, we can try to get you a little more information. But that's basically all we have so far.
Yeah, it was interesting to see these hedge fund managers and fund managers. All of them were aware, none of them were expert, and don't view that it's the type of transaction that their companies were getting ready to participate in now. The one speaker was a hedge fund manager, a manager of multiple hedge funds. He said he personally has a small investment in one of the competitors to Bitcoin, and felt that was, but it was more in the block technology, and he felt that eventually was going to come into play. But he had a small percentage of what his liquid net worth was invested in it, and things like that we consider ultra speculative. Just to give you an idea, even investing in individual stocks, we say no more than 3% in any one stock, of your liquid net worth, no more than 10% in
your total.
In your total of individual stocks, just because the risk is so intense. And I think it's even worse with something that has the volatility of gold, the volatility of Bitcoin, the volatility of oil.
And
futures.
it also depends on what you are putting into that. If this is just play money that you don't, what I mean, that could have a different answer.
With that, I think we have to take a break. Richard, Art will get your information for a gift card, and you'll get out with the same batch I have from 2 weeks ago that I haven't sent out yet. But that should be this week. But Art will grab your information. We'll take a break. This is Dave Weaver and Megan Wall with User Friendly Finance. Welcome back to another segment of User Friendly Finance with Dave Weaver and Megan Wall from SWC Wealth Management. If you have any questions during the week, like I said, give us a call at 717-706-0700. And the Bitcoin question, it's interesting that call came in while we were talking about risk, because I would put that on the at the highest level of risk at this point. It does mean there's not some money to be made, but there's also some money potentially to be lost. And just like Amazon in the early days, Amazon had just as much probability of failing as it did of succeeding. And the early investors the ones that stayed are probably very happy. The ones that were watching it lose for years in the very beginning, as they were making these huge bets on changing how people purchase, it's a huge risk. And when we're in the subject of risk, that would be in the high category. And like when we can look at the continuum of risk in our investment portfolios that we have, and you have fixed income, you have cash, which would be, in our portfolios anyway, you have cash, which would probably have the lowest level of risk, and the higher the risk you take, the higher the potential for return, the higher the probability for big losses at some point. Cash would have the lowest, then fixed income in various types of bonds, then probably large cap, then probably small cap, and international is probably less risky than small cap. And you have to keep your risk in mind as you try to put together your investment strategy for yourself.
And also keep in mind, we are telling you about types of risk not because there's no way to avoid all risk. You just want to make sure that you understand the risk associated with your choices, and make sure you don't have 100% of your money invested in Bitcoin that has that level of risk, or even 100% of your money in cash that is losing its purchasing power. There's a mix to be found for each person in order to help them achieve their goals.
Yeah, it's risk is implied in just about everything you do. Just walking down the street. If you're walking on the sidewalk, you have less risk than if you're walking in the middle of the street. Or
hopefully,
yeah, hopefully less risk. So, going through our list of risks, we still have quite a few versions of risks that we have to go through. We may have to finish this up next week at the rate we're going. But the next thing that we wanted to talk about is liquidity risk, which is the risk of being unable to sell your investments at a fair price and get your money out when you want to. A couple good examples of this that you can just relate to in your personal life are an auction. If you have something that you're putting up for auction at a local auctioneer, the only price that you're going to get is the price that somebody will pay that day. And that's a true look at liquidity risk, because you can't get your money unless somebody buys it, and you can't necessarily direct who's going to buy it that
Yeah,
day.
real estate also can have
Yeah,
liquidity
real estate's
risk.
the other really big one.
As long as you're willing and able to hold it in order to, weather down markets and stuff like that, it's not necessarily a bad investment. But if you possibly are going to need that money immediately in a pinch, then you're going to have to sell it to what someone will buy it for.
Right. And, we fairly frequently have the question of, what do you think about real estate as investment? I don't have a problem with people investing in real estate. I think there's a couple of conditions on that. One is I don't think you want to get over leveraged in it. I think it helps to have somebody, either yourself or somebody that can do work for you at a reasonable price. You have to be willing to undertake a lot of risk with the subject of tenants and who will rent and what kind of condition they'll keep your property in.
And if you have to do all the work and come out in the night to do it, and I would say it pays off a lot better if when you're getting started in real estate, if you're able to do the work yourself, and then once you get a larger portfolio, then that you have the ability to pay someone to do it.
Yeah, and again, it comes down to, I don't have a problem with people investing in real estate, but I think you should still have some liquid cash, because you never know what your situation is going to be in the future. And real estate is not liquid, regardless of the fact that there's stuff for sale every day. You'll find stuff for sale for 30 days, 60 days, a year, 2 years. Not everything sells the day you want it to sell. Just like an auction,
at least not, especially not for the price you want it to.
Yeah, it has to be. The real estate is like just like, I guess, the stock market in the big picture way, in that what you have to sell, somebody has to be willing to buy. The way the stock market works is if you have 100 shares of Amazon that you want to sell, somebody on the other end has to buy it at a price that's fair in the market at that point in time. But somebody has to be there, and if nobody's there to buy it on the other end, the day you want to sell it, you've got liquidity risk.
So even if you're calculating net worth, liquid net worth is different than net worth. So a net worth would include real estate that you own, not your primary residence, but the rest of the real estate that you own. But it just wouldn't be included in liquid net worth, because if you needed money in a day or 2 days, you couldn't have it that quickly.
Right.
The next one is concentration risk.
We have a question on line 1 from Julie.
Morning,
how are you today? Hope you have to turn your radio down, I think.
Good. Hi, thank you for taking my call. I always enjoy. I'll turn it off.
Okay.
Thank you for taking my call. I always enjoy your show.
Oh, good.
I have a question. Like, if you just want to go buy savings bonds, like you used to be able to go in a bank and buy them for your children or for special gifts, or if you want to put some in your folder, where do you buy these? You can't even do that anymore.
I think you actually have to do it online or with your tax return. I think you can get actual bonds, but other than that, I think online is your only option.
Really?
It's getting harder and harder to do. Back in the day, used to be your employee. They would have. I remember I used to work. My first job when I got out of school was with the phone company, and they had savings bonds available to deduct directly for your paycheck. And a lot of employers did that. It was part of a big drive to, a lot of times managers' goals were, their annual raises were partially based on how many people participated in the savings bond program.
Oh.
But it's hard to do now. It's also sometimes hard to get them cash, particularly.
Really?
Savings bonds to me they are paying a really reasonable return. The interest rate is fair, and they're outperforming savings accounts by dramatic amounts. But liquidity now is a problem with those. We were just talking about liquidity risk. It's particularly problematic if people pass away with them. And so when we have older people, we will try to get them to start to cash them in, because passing away with them, if they're not titled correctly, can be a real problem. Sometimes
banks will generally help you out if you have a bank that you work with later on, but you can't buy them at the bank anymore.
In a traditional bank, may cash them, but you may have to get somebody in that day from a different branch to come in and handle your transaction.
That's terrible.
Yeah.
It's a hard thing.
We
and-
had to set up an appointment with a certain person that works for a bank for one of our clients because that person had to be there that day in order to go through
right.
theirs. But you could set up a treasurydirect.org, it looks like, is where you buy them.
treasurydirect.org. Yeah, is the way.
Online, but you do need your grandchildren's name and social security number. Otherwise, you'll have to set up your own account and then later transfer them to them.
Oh, it used to be so nice to go in and get
I
like an
know.
$18 bond, and then 25 years later, it's like worth $25 or more, and it was just a nice, safe gift. I felt that they couldn't, spend them until they finished school of some kind, or
Yeah, what we're doing with our kids is 529s. Like we're taking part of the money every year. We're donating to a 529, which is for education, post-secondary education. It can be used for college or a technical school. But
And if you didn't want it to be tied to school, an UTMA is an idea as well, because that account is in your name until the child turns 18.
and
then you just go and say, I want to take some money out, or do you have to take it all out, or
Whenever it becomes theirs, they can take it all out if they want to. They can do whatever they want with it.
At 18,
It's
becomes
theirs. That's the only reason why some people don't like it, because they don't know that when they're 18, they're going to make the best decision with the money.
Okay.
Well, I hear the music. It sounds like we're going to have to go. Art will grab your information to send you the gift card.
Oh, thank you.
And thank you very much for calling.
Have a nice holiday.
Hey, you
Thank
too.
you too.
Thanks a
Thank
lot.
you.
Yep. This is Dave Weaver and Megan Wall with User Friendly Finance.
Have a great week.
Come visit us next week.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.